Why do you keep buying at the top and selling at the bottom? Why does it feel like every time you finally get the courage to invest, the market suddenly crashes, and every time you panic and sell, it magically recovers without you? If you've ever looked at your portfolio and thought, how am I always this unlucky? This isn't bad luck. It's not bad timing, and it's definitely not because you're stupid. It's because you're human. And today, we're going to break down exactly why this keeps happening, especially to everyday investors across the United States, and how the system, the media, and even your own brain quietly push you into making the worst possible moves at the worst possible times. Let's start with a simple truth. Most people don't buy when prices are low, because low prices feel scary. When the market is crashing, headlines are screaming about recession, layoffs, inflation, or some global crisis. Financial news channels are filled with red charts and dramatic music. Your social media feed is full of panic. Friends are texting about pulling their money out. In moments like that, buying feels reckless. It feels irresponsible. So you wait. You tell yourself you'll invest when things calm down. But by the time things calm down, the market has already recovered. Prices are higher, optimism is back, and suddenly it feels safe to buy again. That safe feeling, that's usually the top. This is called herd behavior, and it's one of the most powerful forces in investing. Humans are wired to follow the crowd. Thousands of years ago, if everyone in your tribe started running, you ran too. It kept you alive. But in the stock market, that same instinct destroys wealth. When everyone is excited and making money, you feel pressure to join in. You see screenshots of gains. You hear stories of someone doubling their money in a tech stock or crypto rally. Sitting on the sidelines feels painful. You feel like you're missing out. And that fear of missing out, FOMO, is often what pushes you to buy at peak prices. Now let's flip it. Why do you sell at the bottom? Because losses hurt more than gains feel good. Behavioral economists call this loss aversion. Studies show that losing $1,000 feels roughly twice as painful as gaining $1,000 feels good. So when your portfolio drops 10%, 20%, or 30%, it doesn't just look like numbers on a screen. It feels like danger. It feels like failure. It feels like you need to stop the bleeding. Your brain shifts into survival mode. And in survival mode, long-term strategy disappears. All you want is relief. Selling gives you that relief. It stops the pain immediately. But often, it locks in the loss right before the recovery begins. In the US market, this cycle has repeated over and over again. During major downturns, many investors panic out near the bottom, only to watch the S&P 500 rebound months later. The people who stayed invested or continued buying during the fear often come out ahead. But in the moment, staying invested feels crazy. The media rarely shows calm charts during crashes. They show worst-case scenarios. They interview the most dramatic analysts. Fear gets clicks. Calm discipline does not. Another reason you keep buying high and selling low is that you don't have a clear plan. If you don't know exactly why you're investing, what your time horizon is, and how much volatility you're willing to tolerate, every market move feels personal. Without rules, emotions make the decisions. And emotions are terrible portfolio managers. When the market rises, greed whispers, "Put more in, you're missing out." When the market falls, fear screams, "Get out before it's too late." Without a written strategy, you bounce between those voices. There's also something called recency bias. Your brain gives more weight to what just happened than to long-term history. If the market has been rising for months, you start to believe it will keep rising forever. If it's been falling for weeks, you start to believe it will never recover. You forget that markets move in cycles. You forget that volatility is normal. Instead, you project the recent past into the future. That projection is often wrong and expensive. And let's be honest, many people don't truly understand what they're buying. They buy based on hype, headlines, or social media trends. When you don't deeply understand an investment, you don't have conviction. And without conviction, the first sign of trouble shakes you out. But when you understand the fundamentals, earnings, long-term growth, diversification, you're less likely to panic at temporary drops. The painful irony is this. The market often transfers money from the impatient to the patient. The people who react emotionally fund the gains of those who stick to a disciplined plan. So if you keep buying at the top and selling at the bottom, it's not because you're cursed, it's because you're reacting instead of planning. You're following feelings instead of rules. And until you understand the psychology behind your decisions, you'll keep repeating the same cycle again and again. Now here's the uncomfortable question. If you know this cycle exists, why do you still fall into it? Because knowing something logically is very different from controlling it emotionally. Investing is not a math problem, it's a behavior problem. You can understand charts, earnings reports, and economic data, but in the moment of panic or euphoria, your emotions override your logic. And unless you build systems that protect you from yourself, you will keep sabotaging your own returns. One of the biggest mistakes investors make in the US is confusing volatility with risk. Volatility is normal. The market moving up and down is not a sign that something is broken. It's the price you pay for long-term growth. True risk is not short-term fluctuation. True risk is selling out of fear and missing the recovery. True risk is never investing at all and losing purchasing power to inflation. But because price drops are visible and immediate, they feel like the real danger, even when they're temporary. Another hidden reason you buy high and sell low is that you're investing money you can't emotionally afford to lose. Maybe it's your emergency fund. Maybe it's money you'll need in a few months. Maybe it's money that represents security for your family. When that money drops, the fear isn't just about returns, it's about survival. That's why having a proper emergency fund and a long-term time horizon is critical. When you invest money you won't need for years, you can ride out storms. When you invest money you might need next month, every dip feels catastrophic. There's also the illusion of control. Many investors believe they can outsmart the market by timing it perfectly, getting in right before a rally and getting out right before a crash. But even professional fund managers struggle to time the market consistently. Missing just a handful of the best days in the market can dramatically reduce long-term returns. And here's the catch. Those best days often happen during extreme fear, right after major drops. So when you sell during panic, you often miss the rebound that follows. Let's talk about social proof. When everyone around you seems confident and optimistic, you feel foolish being cautious. When everyone is scared, you feel foolish being calm. Humans crave validation. In investing, that craving leads to buying when confidence is high and selling when confidence is low, the exact opposite of what builds wealth. The market rewards those who can tolerate being uncomfortable and even looking wrong in the short term. So how do you break this cycle? First, you create rules before emotions show up. Decide in advance how much you will invest every month. Automate it if possible. This is the power of dollar-cost averaging. When you invest consistently, whether the market is up or down, you remove the need to guess tops and bottoms. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this smooths out your cost basis and reduces emotional decision-making. Second, define your time horizon clearly. Are you investing for retirement 20 or 30 years from now? If so, a 10% drop this month is noise. Zoom out. Look at decades, not days. The broader US market has historically trended upward over long periods, despite wars, recessions, political turmoil, and financial crises. Short-term fear fades. Long-term growth compounds. Third, diversify. When all your money is in one hot stock or one trendy sector, every headline feels like a threat. Diversification reduces the emotional intensity of market swings because no single investment controls your financial future. That emotional stability helps you stay invested. Finally, shift your identity. Stop seeing yourself as a trader reacting to every move. Start seeing yourself as a long-term owner of productive businesses. Owners don't panic because their business had a rough quarter. They focus on long-term value creation. When you think like an owner, market drops become potential opportunities instead of signals to run.
Here's the truth. You don't lose money in the market because you're unlucky. You lose money because your emotions are making buy and sell decisions. The market doesn't punish intelligence, it punishes impatience. And the moment you replace emotional reactions with a written, disciplined strategy, that's the moment the cycle begins to break. In the end, buying at the top and selling at the bottom isn't a timing problem, it's a mindset problem. And once you understand that the real opponent isn't the market, it's your own psychology, you finally take back control. So if you've been stuck in this cycle, buying when everyone is excited and selling when everyone is afraid, don't beat yourself up. You're not alone. Most investors go through this phase. But the difference between people who struggle financially and those who build real wealth in America isn't luck, it's discipline. It's having a plan and sticking to it when emotions try to take over. From today, promise yourself this: no more emotional decisions, no more chasing hype, no more panic selling. Create your rules, automate your investing, think long-term. And remember, wealth is built by those who stay consistent when others lose control. If this opened your eyes and helped you understand your own investing mistakes, make sure you subscribe and turn on notifications. On this channel, we break down personal finance and investing in simple, practical ways, so you can stop making costly mistakes and start building real financial freedom. And if you've ever bought at the top or sold at the bottom, drop a comment below and say, "I'm done reacting. Let's build smarter together."